Hi everyone and welcome to chapter 14. In this chapter we are going to discuss about raising equity capital. So let's start. So chapter outline, this chapter covers equity financing for private companies, taking your firm public. So the IPO process, IPO puzzles, so how to navigate the IPO process, raising additional capital, the seasoned equity offering. Learning objectives are contrast the different ways to learn to raise equity capital for private company, understand the process of taking a company public, gain insight into puzzles associated with initial public offering, explain how to raise equity capital once the company is public. So sources of funding, a private company can seek funding from several so let me explain it to you on Excel and then we can come back and cover the slides. Okay, so let me open an Excel first. So just the basics of this. So this chapter is about finding external financing. So when you start a company, okay, what are the possible sources of financing that are available to you? So you can use your own money, okay, you can issue debt, or you can issue equity. It can be private or public. So if you use your own money, you have limited amount of money with you. You may not have the money that is required to expand your company, right? If you issue debt, then you have to pay interest, which is a fixed expense. And that can be risky, right? That would be extremely dangerous. If you can't pay that fixed expense, your company can go bankrupt. With equity, the thing that you do is you give out ownership. So when you raise finances, when you raise external capital using equity, you give out ownership. So you give out some ownership, get money on that behalf and use that money to grow your pie, to grow your business. So in this chapter, we are going to discuss about raising equity. So how you can raise money from the source of equity from external players. Now, depending on what stage your company is in, equity can be raised from different players. So when your company is small, right, when it is only idea based, you raise money from angel investors. Who are these angel investors? These are generally wealthy individuals. So wealthy individuals, they are not corporations. It can be friends and family that can be your angels, or it can be professional players, wealthy individuals who like your idea. So you start your own company initially, then you go to angels, okay. After that you go to venture funds. Then you go to venture funds. Venture funds are little bit later than the idea stage. So when you actually have a product, that's when you go to a venture fund, okay. These are generally corporate entities, okay, which fund early stage companies. So again, you raise some money, your company is doing well, you start growing, then you can go to institutional investors, that is private equity. It is with little bit late stage financing, okay. And finally you can do an IPO in which so what is private equity before we go to IPO? Private equity is when you have product and proven product, I would say proven product. These are again corporate entities that give you money. And finally you can do an IPO. In IPO you go to general public. So you ask for investing public, like stock, you get listed on the stock market and you ask general public to give money to you so that you can expand further, okay. So this is how a company's life cycle works. So you start a company on your own as a partnership, or as a sole proprietorship. Then you go to an angel investor to raise money. Then you go to a venture fund to raise money. Then you do a private equity rounds, and finally you do an IPO and you get listed on the stock exchange to raise additional capital. Okay. So in this chapter, we are going to discuss this flow. We will start with angels, ventures, private equity, then discuss the IPO process and proceed further. So let's start with it. Okay. So, sources of funding. A private company can seek funding from several potential sources. It can be angel investors at the idea stage, then venture capital firm, little bit progress, but not a finalized, not a proven product yet. Then institutional investors, which is private equity, or it can be corporate investors. So firms that are in the same line of business. Right? Example, if you're a tech company, you can get funding from big tech players like Microsoft or Google. So that is strategic investment. That is not dumb investment. Okay. So these are various sources of funding for a private company. So what are angel investors? These are individual investors who buy equity in small firms. The first round of outside private equity financing is generally obtained from angels. So you can conceptualize them as friends and family. So you start a business, you need capital to grow. So you generally raise money first from friends and family. So friends and family or some wealthy people you know are angel investors. Then comes venture capital firms. They specialize in raising money to invest in private equity of young firms. In return, venture capitalists often demand a great control of company. So angels are different than venture funds. Angels are individuals. Ventures are corporate entities. So they are institutions, okay, that generally help out early stage companies. One more difference is angel investors generally don't demand board seats, but venture firms generally demand board seats. So you may have a board of directors in which venture firms may demand seats of their own. Then comes institutional investors. These are pension funds, insurance companies, endowments and foundation. They may invest directly or they may invest indirectly by becoming limited partners in venture capital firms. And this trend has increased a lot. So initially, pension funds, insurance companies and endowments were shying away from early stage companies. But like now they have started allocating like 5 to 6% of their capital into these early startups, because the gains are a lot, right? If one company hits, like imagine investing in Google when it was just at the idea stage, the gains that you would have got are exponential. So that's why institutional players have also started to venture into venture funds. Then there are corporate investors. Corporate investors are firms that are aligned with your business model. So if you are a biotech company that is coming, like that is a small player right now, maybe Johnson and Johnson, a pharma company, right, or Moderna or Pfizer may invest in you. So they, along with money, they also bring in expertise. So that's why corporate investors invest. Many established corporations possess equity in younger private companies. So these are generally strategic objectives like that the corporate has. Example, like Microsoft did not have a social media platform for a long time. And if you see Facebook's IPO, Microsoft was an early stage investor in Facebook. They put in their money to work at Facebook. Same way, Facebook also bought out Instagram, WhatsApp, all those were strategic investment. They also were early stage investor in Oculus, that is their VR headset platform. So all these are examples of having strategic investments. Securities and valuation is important. When a company decides to sell equity to outside investors for the first time, it is typical to issue preferred stocks rather than common stock to raise capital. And generally it is a convertible preferred stock if the owner can convert it into normal stock. So how does this work? In early stage financing, especially venture firms don't go for direct equity. They go for preferred stock. So preferred stock in this context generally pays you fixed kind of dividend or interest, so 2 to 3% each year, so that they're putting their capital to work. Plus, they have an option to buy into the company. They have an option to convert it into common stock, right? So let's say if you're investing in I'm a venture firm and I'm investing in you. So I may structure a deal so that first 3 years you pay me a fixed return, and after 3 years that fixed return gets converted into common stock, so that little bit of my risk is hedged. So let's do this example. So you founded your own firm 2 years ago. You initially contributed $100,000 of your money and in return received 1.5 million shares of the stock. Since then, you have sold an additional 500,000 shares to an angel investor. You are now considering raising even more capital from a venture firm. So what is happening? You started a firm with 100,000 of your own capital. Then you got an angel on board for 500,000, right? Where you gave up 500,000 additional shares, and now you're looking for VC funding. So let's see how it works. This VC would invest $6 million and would receive 3 million newly issued shares. What is the post-cost valuation? That is what we have to find. Assuming that this is VC's first investment in your company, what percentage of the firm will she end up owning? What percentage would you own? What will be the value of your shares? So what is happening in terms of number of shares? So you have 1.5 million shares with you. You have given out 500,000 shares to angel, and you're issuing 3 million shares to VC. So in total, your firm has 5 million shares. Okay. Now VC is paying $6 million for this 3 million shares. Okay. VC is paying $6 million for this 3 million shares. So valuation per share is $6 million divided by 3 million shares. So $2 per share is VC paying. So what is the total value of the firm? So $2 per share, and the total shares that the firm has is 5 million. So total value of the firm is 5 million into 2, that is $10 million. So out of that, this is your share, this is VC share, and this is firm share. So the post money valuation will be the total number of shares, 5 million, multiplied by the price paid by the VC, that is $2 per share. The percentage of firm owned by VC is her share divided by total number of shares. Your percentage will be your shares divided by the total shares and value per share, and the value of your shares will be the number of shares multiplied by share price. So they're finding it out. So there are 5 million total shares. VC paid $2 per share. So the post money valuation will be 5 million into $2, that is 10 million. Because she is buying 3 million shares and there will be 5 million total shares, the VC will be owning 60% of the firm. Okay. You will own 1.5 million divided by 5 million, that is 30% of the firm, and your valuation will be 1.5 million shares into $2 per share, that is $3 million. So what is happening? You start a firm with 100,000, you did a VC round of funding, so your valuation has gone up from $100,000 that you put in to right now $3 million. Funding your firm with new equity capital, be it from angel investor or venture capital, involves a trade-off. You must give out part of your ownership of the firm in return for the money you need to grow it. The higher the price you can negotiate per share, the smaller is the percentage of your firm you have to give out for amount of money. So whenever you start especially I highly recommend you reading the Facebook IPO. Facebook's owner Mark Zuckerberg was extremely stringent with equity. He did not give away much of equity in VC funding. He used to negotiate for 2.5%, 3% of his equity. So he kept a lot of equity with him. Even right now he has 57% of voting rights with him and almost 22% of stock ownership with him. So you have to be, whenever you're a VC, whenever you're an owner, do not give out equity for cheap. Negotiate very hard. Exiting an investment in private company. How do private players exit? So the VCs that are investing in you, or let's say the angel investors that are investing in you, how do they exit? So they exit by acquisition. So if a firm is acquired by some corporate entity, so let's say Oculus. Initially, Oculus had founders. Oculus was acquired by Facebook. So then the initial investors as well as founder make an exit. Or you can do a public offering where you do an IPO and get the investing public to buy your company. Then you can do an exit. So taking your firm public, the process of selling stock to general investing public for the first time is called as an IPO, initial public offering. What are advantages and disadvantages of going public? Advantages is greater liquidity. So you can always, as a founder, you can always sell your stock if you want in stock market. So liquidity increases a lot. You're not stuck with your holdings. And you get better access to capital, and this is very important. Most of the companies go public not for money but for access to capital in future. You can always do and follow on public offering whenever you want money, or you even debt market start supporting you, like you get into different federal plans. So that is very important. So access to capital, access to future money improves a lot. Disadvantages: equity holders are more dispersed now. So investing public takes a stake. So you have more number of owners, and you must satisfy requirements of public company. Mostly the requirements are that you keep on publishing your financial report. So you have to keep on publishing financial statements, right? Especially quarterly, and you have to publish it quarterly, then yearly. Every quarter you have to you have to do an investment call, you have to state what's happening, and along with that, if any major decision takes place, major thing take place, then you have to disclose that too. IPOs include both primary and secondary offerings. So IPOs are done generally by underwriters. So how does the IPO process work? So let's discuss that and then come back. So what are the steps to do an IPO? So step 1 in an IPO, so you have your firm, you firm contacts an investment bank. Okay, because your expertise is not raising money, your expertise is doing your whatever business you are doing in, but investment bank's expertise is raising capital. So you contact an investment bank. Okay, step 2, investment bank will study your company and agree or disagree to do an IPO. They may consult with you and study your financial statements, discuss with you, and they may agree to do an IPO, or they may disagree if they do not want to do it. They don't find you promising. Step 3, once the investment bank agrees to do an IPO, they will do the following steps. They will file a red herring prospectus with the regulator. What is red herring prospectus? It is an initial prospectus. Doesn't have all the details, doesn't have share price and all those stuff, but it's a red herring prospectus. It's an initial prospectus that they file with the regulator. Step 2, they will do valuations on your company and find out total value. So they will find out what is your company worth right now, how much share you're willing to give out of that worth, right? And IPOs are generally done for two purposes, either for raising money and or for giving exit to initial investors, maybe founders. So raising money means company gets some money, initial investors don't get that money. So company uses it to expand. Exit to initial investors means people who have already brought the company stock initially, like the venture funds, angel investors, or the founders. They want to sell part of their holding or all of their holding. Okay, so they will negotiate how much money will go to the company, how much money will go to the initial investors. So then they do a process of road shows and book building. What is a roadshow? Roadshow is they go out to their to institutional investors like pension funds and hedge funds and endowment funds, and they discuss your IPO and they try to gauge what is the demand, right? And how do they gauge it? They take return commitments from these institutional players, right? Those are not binding, but these are like expression of interest. So they take expression of interest from these institutional investors, whether these institutions want to buy your IPO or not. Okay. And that is called as book building. So expression of interest, right? And at what price do they want to come in? That's where book building happens. Finally, they decide a price which you can negotiate. Decide a price for your IPO. Okay. And if you're okay with that, file a final prospectus. What is a final prospectus? Final prospectus is filed with the regulator. It gives the entire detail. What are the risk factors for your company? What are the valuation metrics they have used? What is the share price that they're selling at? And step 4, they do underwriting. Now what is underwriting? Underwriting means they buy stock from you and sell it in the market. They buy stock from you and sell it in the market. And they create a spread, that is their commission. So let's say they buy stock from you at $40 and they sell it in the market for $42. Okay, that's how they create the spread. And finally, the company gets listed in the market. So this is the basic IPO process. We're going to discuss it in the PowerPoints too. But you contact with an investment bank. Investment bank will study your company and agree and disagree to do an IPO. Then the investment bank files an initial prospectus with the regulators. Now regulators are different. So if you're a Canadian company, there is a provincial regulator. So if you're in the province of Alberta, you file it with the Alberta Security Commissions. And if you're in Ontario, you file it with Ontario Security Commissions. But if you're a US based company, you file it with SEC, Security Exchange Commissions. They have a centralized regulator. In Canada, we have provincial regulators. Then you do valuations. We have discussed valuations in the last chapter, mostly discounted cash flow valuations. Then you raise capital, or then you decide whether the company gets the money or initial investors get the money. Then you do roadshows to gauge out interest from institutions and build a book where they mention a price at which they want to buy. Decide price for the company with consulting with the firm and create a final prospectus. Then underwrite, that is buy the stock from the company and sell it in the market. Finally, the company gets listed. Okay. So IPO includes both primary and secondary offerings. Primary means the company is raising money for the first time. Secondary means you can again raise money. If you're already listed in the exchange, right, you can again come back to the market and raise additional capital. Underwriting and syndicate. Underwriter is an investment banking firm that manages the offering and designs the structure. Now sometimes the issues are so big that one firm may not be able to underwrite the whole issue, because they have to buy the stock from you and then sell it in the market. So let's say Airbnb is a $30 billion IPO. Airbnb is coming up with an IPO and it is $30 billion. So one firm may not be able to do the whole issue. So then they form a syndicate. So syndicate is 2 or more companies coming together to do an IPO. So syndicate, other underwriters that help market and sell the issue. Regulatory filings. So there are two regulatory filings that you have to put in. The initial red herring prospectus, part of the registration statements prepared by the company prior to doing an IPO, that is circulated to investors. And final prospectus, part of the final registration statements prepared by the company prior to an IPO, that contains all details. Valuations, underwriters work with the company to come up with a price. They estimate the future cash flows and compute the present value, or they use market multiples, like they find out what is the equivalent company trading for, and then they value based on that. Then roadshows are done. Roadshows are where you connect with institutional investors to gauge their interest, and book building is taking interest from those institutional investors to find out what price would work for them. Key definitions and terms that you will come across in the IPO process: underwriter, an investment firm that manages the security issuance and designs the structure. Primary offering, new shares available to a public for the first time. Secondary offering, an equity offering of shares sold by existing shareholders. Lead underwriters, if two or more companies are coming together, one company generally takes the lead. So primary investment banking firm responsible for managing the security issuance. A syndicate, a group of underwriters who jointly underwrite and distribute the security issuance, the registration statement. A legal document that provides financial and other financial information about the company, that is generally given in the prospectus. So how to value a firm using comparables? So let's discuss that. So Wagner Inc. is a private company that designs, manufactures and distributes branded consumer products. During the most recent financial year, it had a revenue of 325 million and earnings of 15 million. Wagner has filed a registration statement with SEC for its IPO. Before the stock is offered, Wagner's investment banker would like to estimate the value of the company using comparable companies. The investment bankers have assembled the following information based on the data of other companies in the same industry. So what is comparables? You generally look at valuation metrics from companies that are in similar line of businesses. So the investment bank has gathered data in the same industry that has recently gone public. In each case, the ratios are based on IPO price. So these are companies that have gone public in recent times. So Ray Products, then this BF company, Fashion Industries company, Recreational Internationals. So these are the earnings multiple, price earnings multiple. These are price revenue multiples. So how much is the price as compared to earnings? How much is the price as compared to revenues? And then you compute average. So what you do is you take this average and multiply it with Wagner's earnings and Wagner's revenue to find out what price the share should trade at. After the IPO, Wagner would have 20 million shares outstanding. Estimate the IPO price for Wagner using price earnings and price revenue. So what do? Price earnings, whatever price earnings is there, 21.2 average, right? You multiply it with earnings. So 15 million into 21.2 is the total value of the firm, divided by how many shares you're offering, 20 million, to get price per share. Same way, you take average price revenues 0.9, you multiply it by total revenues, that is value of the firm based on revenues, and then divide it by 20 million. So let's see how they do it. If IPO price of Wagner is based on price earning ratio that is similar to those of recent IPOs, then this ratio will be equal to price earnings of recent deals. Thus, to compute the IPO price based on PE ratio, we first take the average PE ratio from the comparison group and multiply it by Wagner's total earning. This will give us the total value of equity for Wagner. So the same thing, take the average, multiply it by revenues or earnings, right? And then divide it by number of shares to get price per share. To get price per share of IPO, we need to divide the total equity value by number of shares that are outstanding, 20 million in this case. The approach will be the same for price to revenue. So 21.2 is the average. multiplied by 15 million, that is the revenue, you get total value of the firm 318 million, divided by 20 million of share outstanding, you get price per share 15.90. Similarly, Wagner's IPO price implies a price to revenue multiple of 0.9. So take this 0.9 multiplied by 325 million to get the total value of the firm 292.5 million, divided by 20 million outstanding. So you get revenue, price per share based on revenue. We found in chapter 7 using multiples for valuation always produces a range of estimates. You should not expect this to get the same value for different ratios. Based on these estimates, the underwriter would probably consider a range of IPO from $13 per share to $17 per share. So they will give out a range in a roadshow and ask institutional investors which price they want to come in. Okay, so let's continue. So pricing the deal and managing risk. There are different ways to do underwriting, the final process. So firm commitment IPO, in which the underwriter guarantees that it will sell all of the stock at the price that you have derived. So let's say we decide a price of $15 per share for the company Wagner. Then if it is a firm commitment IPO, then Morgan Stanley, JP Morgan, or whichever, like in Canada, the two biggest investment banks are TD Securities followed by RBC Capital. So if they agree, they will agree to sell all the stock, right? That is there. Then there is also a greenshoe option or a over allocation option. So in which allows the underwriter to issue more stock amounting to 15% of the original offer size at the IPO's offer price. So this is generally an option that underwriters demand that they have. So if the IPO is very successful, there is a lot of demand from institutional players, then investment banks gets additional option of issuing 15% extra shares. So if you wanted to raise let's say $30 billion, and if the IPO is really in demand, then these players get additional 15% to sell. Other IPOs types, there is best effort basis. The underwriter does not guarantee that the stock will be sold, but instead tries to sell the stock for the best possible price. Auction IPO, the company or its investment banker auctions the share, allowing the market to determine the price. So this is little different. So most of the IPOs that are done in North America do not follow the auction method. What is the auction method? Instead of underwriting buying the stock first from the firm and then selling it in the market, underwriters are cut out, right? So they do consult with the firm still, but the firm directly sells the stock to investors rather than selling it to underwriters and then selling it in the market. The firm directly takes interest from individual or institutional investors and then they decide the price. So it's an auction process. So investors, institutions or individuals bid on the company's price directly, and this was done by Google first, right? Not many North American companies actually do an auction IPO. But if you go in emerging markets like China or India or Singapore is not emerging, but still if you look at those markets, few of the IPOs that are done there are auction based. So let's see how that works. So Fleming Educational Services Inc. is selling 500,000 shares of stock in an auction IPO at the end of the bidding period. So how does it work? So it is selling 500,000 stock. So it will open a bidding window. So let's say 30 days, 7 days, whatever it decides. So within that 7 days or 30 days, people will bid how many stocks they want and at what price they want. So it has received following bids. So at $8, 25,000 shares people want. At $7.75, 100,000 shares they want. $7.5, 75,000. What will be the offer price of the shares? So how will offer price be determined? So they start at the top, right? And they decide a price at which this 500,000 shares will be fulfilled. So how do they do that? So $25,000, 25,000 shares go. So out of 500,000, 25,000 have gone. So 475 are left. Then 100,000 shares go. So 375 are left. Then 75 go. 300 are left. Then 150 go. 150 is left. Then 150 goes. So 0 is left. So IPO price will be decided $7. So let's work it out. First, we must compute the total number of shares demanded at or above the given price. Then we pick the lowest price that will allow us to sell the all 500 shares. Okay. So convert the following bids into cumulative. So 25,000, then 25,000 plus 100,000, 125, 100,000 plus 175, plus 75, 200, 200 plus 150, 350, 350 plus 500. Okay, 500. 350 plus 150, 500. So we added everything. So 25 plus 120 plus 100, 125. 125 plus 75, 200. 200 plus 150, 350. 350 plus 150, 500. We reached 500. That will be the price that is decided. Okay, so we made cumulative. The company has received bids for a total of 125,000 shares at $7.5. So they added it up. Fleming is offering a total of 500,000 shares. The winning auction price would be $7 per share because the investors have placed orders for a total of 500,000 shares at $7 or higher. All investors who have placed bids, right? So price that will be decided is $7 per share. In this example, the cumulative demand at the winning price exactly equals the supply. If the demand at this price were greater than the supply, the auction participants who bid higher price than the winning price would receive their full bid. Shares will be awarded on a pro rata basis for bidders who bid exactly the winning price. While the auction IPO does not provide the certainty of firm commitment, it has advantage of using market to determine the offer price. It also reduces the underwriter's roles and consequently the fees. Now, whenever IPOs are done in North American markets, people have noticed that these things happen. So, underwriting of IPOs results in underpricing of IPOs. So, whenever most of the IPOs, when they get listed in the stock market, on the listing day, they go up. Now, what is the reason for that? Now, underwriting firm, investment banking firms are responsible to sell the stocks, right? So they on purpose underprice it because they reduce their risk of selling the stock, because if they are not able to sell the stock, they have to buy it themselves, which they do not want. That's why most of the investment banking firms generally underprice the IPO. So if the market price is $40 that the market is considering, they will sell it at $38. They will derive the price at $38, which is little lower than what would market essentially pay. That's why when most companies IPOs get listed, they generally jump up. Example for that will be a recent IPO that was done. So let me show you that. Palantir is a software company that did recent IPO. So it got listed at $9, right? And this jumped up since IPO because most companies generally underprice that IPOs. Most investment banks generally underprice it. So this is one phenomena that you have to always remember. Then IPO markets can be hot or cold. When the stock markets are doing really well, there are more and more IPOs that come out. When markets are struggling, the IPOs dry up. Then there is very high underwriting cost. So investment banks generally charge 7% of the total issue price as their fees. Then most IPOs in 2 to 3 years after their IPOs, they do their IPOs, struggle. So they do not beat the overall stock market. Underpricing IPO. For the Facebook, the underwriter offered the price of $38 per share, right, on May 28th, 2012. The Facebook stock opened trading on Nasdaq at $42. So it was underpriced. Initial investors got it at 38, but when it opened on stock market, the trading started, it went up to $42, and traded as high as 45 before closing at 38.2. This lack of underpricing is not typical. When Twitter had its IPO, the stock closed more than 72% above its offer price on first day of trading. Who wins and loses because of underwriting? So in firms, founders and initial investors generally lose out because of this underpricing issue. Hot and cold IPO markets. It appears that number of IPOs is not solely driven by demand of capital. Sometimes the firm and investor seems to favor IPO. At other times, firms rely on alternative sources of capital, maybe private equity or debt markets. In US, the discount below the issue price at which the underwriter purchases the share is generally 7%. In Canada, it is 6%. So there is high cost of doing an IPO. The fee is large, especially considering the additional cost to the firm associated with underpricing. Poor post-IPO long-run performance. Newly listed firms appears to perform relatively poorly over the following 3 to 5 years after their IPO. That underperformance might not result from the issue of equity itself, but rather from conditions that motivated equity issuance in the first place. A firm's need for outside capital rarely ends at an IPO. So after an IPO is done, generally firms do an SEO, that is seasoned equity offering. These are firms that are already listed in the market, coming up again with an SEO to raise additional capital. Example will be Tesla. Tesla was listed in 2010, but it did an equity funding offer right now, like 2 months back in 2020. Why? Because they needed additional capital. Firms return to equity markets and offer new shares for sale. The SEO process. When a firm issues stock using SEO, it follows the same steps at an IPO process. The main difference is the price setting process is not necessary because the price is already there in the market. But tombstones are there. That means generally the price that is offered in an SEO when follow-on public offering is done is little bit lower than the market price. So firms give discount to sell their stock. Two kinds of seasoned equity offerings are there. Cash offers, right, means anyone who wants to buy the stock can buy the stock, or right offers. Right offer means shares extend those stocks, the new additional stocks. Companies extend those new additional stocks only to existing shareholders. New shareholders are not allowed to buy stock. If you have the stock, company will sell you additional stock. You are an CFO of a company that has a market capitalization of $1 billion. The firm has 100 million shares outstanding. So the shares are traded at $10 per share. You need to raise 200 million and have announced a right issue. Each existing shareholder is sent one right for every share he or she owns. So what is happening? It's a right issue. Right issue means only existing shareholders have the right to buy those additional shares if they want to. Okay, so share price is $10. They want to raise additional 200 million, right? And how will they do it? So you have not decided how many rights you will require to purchase a share of new stocks. You will require either 4 rights to purchase one share at the price of $8 per share, or 5 rights to purchase the 2 new shares at $5 per share. Which approach will raise more money? In order to know how much money will be raised, we need to compute how many total shares would be purchased if everyone exercises their rights. Then we multiply it by price per share to calculate the amount raised. So there are 100 million shares, each with 1 right attached. In this case, 4 rights will be needed to purchase a new share. So 25 million new shares have to be purchased at a price of $8 per share. That will be 200 million. In the second case, for every 5 rights, 2 new additional shares can be purchased. So in this case, it will be 2 40 million new shares at a price of $5 per share, it will be 200 million. So if all shareholders exercise their right, both approaches will raise same money. So what is the bottom line? Whenever you do a right issue, the share price in the market goes down. So you have a new share price. Instead of $10 per share, you can have it at $8 or $5. But you will issue additional stocks to shareholders. In both cases, the value of firm after issue is 1.2 billion. So total value doesn't change. In the first case, there are 125 million outstanding shares. So the price per share is $9.60 after the issue. This price exceeds the issue price of $8. So market price will be little bit above than the issued price. So the shareholders will exercise their rights. Because exercising will yield a profit of 0.4 per rights, the total share price will be $10. In the second case, the number of share outstanding will grow to 140 million, resulting a post-issue price of 8.57. Again, the shareholders will exercise the right and receive total $10 in value. Researchers have found out that on an average, the market greets the news of SEO with stock decline. So whenever there is news that a company is coming out with an equity issuance, it is issuing new stocks, the stock price will go down. Often the value lost can be significant fraction of new money raised. There is adverse selection lemon problem. So lemon problem means the market will think, why are they giving out more equity, right? Why is the company increasing its shareholding process? That is the lemon problems. Because if company is valued, founders and management will buy into the company rather than sell their stock. SEO cost. In addition to the price drop when an SEO is announced, the firm may pay direct cost as well. Underwriting fees amount to 5% of the proceeds. So the SEOs are extremely costly. So that completes the chapter. See you in the next module.